Hey everybody, good morning. It is 8:56 in the morning. It's the 30th of March, 2021, and what I'm going to be doing today is going through a trade that I had posted in our Discord, and I want to explain what it is. And this is a call credit spread. It's an alternative to playing just a simple put or even a call if the configuration is right on options. And I want to focus on this because there's a lot of people out there that see things with options, and what I want to do is I want to go through a more conservative way to play options to reduce your risk. Yes, it's going to reduce your potential return as well, but what I'm going to outline here is when you're playing options that are really close to expiration, I would suggest potentially doing it a different way. And so I want to talk through that here just really quickly. So yesterday on the Discord, I posted a trade. Basically, we were going to short SPY near the end of the day. And what I said was I'm going to be opening a call credit spread on SPY for March 31st, which is tomorrow. And I'm going to be buying the 400 and I'm going to be selling the 399. I want to talk about what that is. And I was looking to get a 29-cent credit. I was seeking a 30-cent credit, but that didn't fill. I lowered my credit to 29 cents in order to get my fill before the end of the day. So let me go ahead and share my screen. And I want to take a look at this, okay? So these are prices as of the end of the day. These aren't the actual prices that I got, although the credit is, approximately the same. And I'm actually looking at April 1st. I'm not looking at March 31st. So the credits are very similar, but it's not exactly the same, and it does not reflect what the prices currently are because SPY has dropped a bit. So I'm using this in Robinhood because I've already done an informational video for our members. I've already done an informational video for the members that that show how to do this inside of Thinkorswim, TD Ameritrade. But anyway, I'm looking to short SPY. So you can do this, many different ways. Many different ways this can be done. But what I do is I like to do verticals, and I want to explain why. The first thing, I want to show you a website that I use quite a bit when I calculate my P&L for the options that I get into. I want to show you yesterday, the price of the S&P was somewhere around, let me pull it up over here. Let's see here. SPY. The price of SPY yesterday was, at the end of the day, it closed around 395, almost 396. So that's basically where we closed yesterday. So we closed out somewhere in between this 395 and 396. And I said, we need to short SPY, all right? And so a lot of people would say, all right, well, I'm going to get the 395 put. The one, that next strike down, I'm going to get that put. All right, well, let's just take a look at what would need to happen if you were to get a near-dated options expiration. So this is looking at getting a put for March 31st, the same that I got, right? So this is, at the time, it was 2 days to expiration. And we're looking at a $395 put. So, the price at the end of the day was about $1.59 per contract, all right? And so what that means, though, is for you to break even, the price of SPY has to go down to about $393 and 41 cents. I think my math is right there. $393.41. Yes, break even at expiration is $393.41. All right. But is it going to go down that low? I don't know. We're at $394.13 right now, so we're still not at break even. And we're talking about break even, not profit, all right? So let's go down and take a look at the chart. So you can see with a regular put on SPY, right, we're going to be in a little bit of profit. So right now it's at 394.16. So we should be at about 50% profit right now. But what if that didn't happen? What if SPY just remained flat? What if it didn't move in your favor? Well, that's why I play verticals, and I'm going to explain why. Because what we got here, not what we got, but what people would potentially be looking to get is a put that is like one strike below, which is the safer bet. But we're looking at, in my case, I was looking at 2 days to expiration. So, getting a $395 put, that price has to move. It has to move almost immediately in your favor. Otherwise, as you see, if it had just moved sideways, you'd already be losing money. Then you'd be holding on to it, hoping that it drops, and then you'd be losing even more money. And then basically, if it doesn't go below 393.50 or so, well, then you're losing money. So the trade that I suggested was, again, to sell the 399 and buy the 400. And these are really simple things to do. So let me just show you what you can do here. All right, essentially what we're looking to do is click on the buy, and then we're going to be buying again. We bought the 400 and we sold the 399. So you're going to click on buy call, and so we're going to be buying the 400. So you're going to click on that 74 and you're going to sell the 399. So then you're going to flip over to sell, and then you're going to click on the 399. Here, I've got, again, you're going to see that both of these are going to be shaded. I've already sold that 399, so that's why it is not allowing me to buy it, because that would kind of negate that trade. So again, I'm going to be buying the 400 and selling the 399. And what that means then is I'm expecting it to go down, and I'm going to receive a credit for this. And we received a 29-cent credit for this. Now, let's talk about how this vertical is going to work then. We have a $1 spread. So between 399 and 400, there's a dollar in between, which means the most this is going to be worth is $1. Okay? Most it's going to be worth is $1. So let's take a look at this credit spread. Again, these are the actual numbers from the trade that we're currently in. We're looking at SPY. We bought the 400 and we sold the 399. And so the 400 that we got was worth 76 cents, and the 399 that we got was worth $1.05. Okay? And we were looking at a 29-cent credit. Again, I was trying to get 30 cents because every penny that this goes up is going to increase your probability just a little bit. So if we go down here and take a look, the chart looks much different. And actually, as time goes by, your window of profitability actually increases, whereas if you're taking a look at the 395 put, your window of opportunity actually decreases. Your profit potential increases, but again, the price really has to move in your direction in order for this to really be worth your time. Okay? It really has to move in your direction. This is why I'm not a huge fan of just straight options. I prefer verticals. They're more conservative, but that's just me. I like to be more risk averse. But again, as long as SPY stays below 399, this is going to be a 40% trade. Per contract, it's going to be worth that credit. So we basically got $29 credit for each contract that we got. Your maximum risk is $71. That's the most that you're going to lose. Per contract, the most you're going to lose is $71. The most you're going to make is $29 per contract. Okay? I got more than one contract. That's the way it works. And basically, you're looking at at most a 40.8% trade. Now, I can close this out today. I'll be able to close this out, at a certain percentage point. If I remember correctly, this particular trade was already up 24% as of yesterday. And as time goes by, theta is actually going to work to our advantage, and the value of this is actually going to decrease. And that's exactly what we want. When we're getting a credit, you're selling, and you want to buy it back or let it expire worthless. You want to buy it back lower, and then you keep the difference. Okay? So you're actually looking for that price to decrease over time. And for me getting the 399 400, what that means is as long as that price stays below 399, I'm going to be making money. I'm going to be making money. And the most that I can make is 40.8% of my risk. All right? My risk is $71. Okay? And if I make $29 on that $71 risk, that's what equals this 40.8%. That $29 is 40.8% of my risk. All right? Now, you can look at it a different way. When I say that trade is up 24%, Well, that means that it has decayed 24%, right? So you can look at it two different ways. But at any rate, as far as what I have on the table as risk, which is $71 per contract, I'm looking to make potentially $29. I will settle for less. I may scale out of my position because the way that these work, you're really limiting your risk, you're limiting your reward, but you're limiting your risk. And it's a lot more predictable as well. And your probability increases also. And I think that's the key point. Your probability increases by playing something that's more conservative. Your reward isn't as great, but your risk isn't anywhere near as great if you were to just get a straight put on SPY. You know, if I say short SPY, sometimes I'll just get into SPXU. It's just a 3x bear asset on the S&P 500. But in this particular case, I said, you know what? I don't think SPX is going to break 4,000 this week. I don't think it is. So I'm going to get something that expires in a day or two. I want it to decay and expire worthless. And the way that I had this trade set up, SPY could actually go up 3 or 4 points and I would still make money. I would still make money. Whereas if you got that 395 put and the price went up, what would happen to it? It would almost instantly start losing exponentially because you're already out of the money and you're now even more out of the money if SPY went up. Now, I think we made a good play yesterday, and I think getting that 395 put is going to pay off. But what if it didn't? What is your risk? What is your risk? Well, getting that 395 put, you know, looking at that at $1.59, your risk is $159 per contract. And not only that, but your return, it is only good if the price goes down. But if it goes up, I mean, look at this. If the price happened to go up to 397 on March 30th, which is today, you'd be down 32%. And if it just continued to stay at 397, well, you'd be quickly on your way to 100% loss. Whereas on the call credit spread, I mean, if it went up to 397, yeah, you'd be down 5.63%. But if it just stayed there, the next day, you'd be up 21%. And then if it continued to stay there, well, there you go. There's your full max profit. And again, the max profit is $29 on a $71 risk. So I wanted to outline this because I'm going to be posting a lot more of these types of trades in the insured area on the Discord. And I want to make sure that you understand how it works. I'll be doing more private videos for our members explaining the trade, why I take the trade, how we take the trade, and hopefully we'll be able to become more proficient in taking these types of trades. Yes, they do not have a huge amount of reward if you are right, but they don't carry a huge amount of risk if we're wrong. And actually, the way that I'm going to be taking these trades, it will allow the price to go against us a little bit and still be able to profit on the trade. All right, guys. Thanks for watching. I hope this video did help you. If this video did help you in any way, shape, or form, you know the deal. Like, subscribe, share, all that good stuff. And of course, wherever you are in the world, I hope you're having a good day, good night, and a good evening.